We had the Fed meeting yesterday, and boy, it was an exciting one. If you missed it, you missed out. Just kidding. You really didn't miss out. It wasn't that exciting. The Fed just kept the federal funds rate unchanged. We're still between 5.25% and 5.5%. And we didn't really see that much crazy movement in the markets or anything. We did, however, get one pretty interesting event to happen yesterday. So I'm going to be talking about that in this video, and I'm just going to be talking the FOMC meeting and the impact of the Fed's decision on different markets. Before I do get into it, please make sure to like the video and also subscribe to the YouTube. If you're a returning viewer, I appreciate you coming back and sticking with me. Let's get into it. So, like I mentioned, the Fed decided to leave the federal funds rate unchanged, which is what most people were expecting. I don't think anybody really thought they were going to raise it, and maybe a small select few thought they were going to cut. In the conference after they made the decision, Fed Chair Jerome Powell acted pretty dovish. He was asked in there if the Fed planned on raising the federal funds rate more this year, and he basically brushed it off and said that he didn't think that would be necessary. He always says that they're going to be data dependent though, and it's going to depend on the data. That's his main line. But he acted pretty dovish throughout the meeting, and just his tone and the way he answered questions were dovish. And I was listening to some people and analysts talking about this meeting, and they were talking about how this is bullish for the markets and the stock market in particular. And I'm not sure if I agree with that. Let's take things back a couple months. Let's rewind a little bit. End of last year, the Fed is forecasting that we're going to have up to 6 rate cuts this year. It is now May. We're getting close to the middle of the year, and I haven't seen any rate cuts. And I don't know if we're going to see rate cuts this year. And I've talked about why the Fed can't really cut rates too much in my previous videos, right? Because it will lead to higher inflation, which means that people might not buy treasuries. They may buy other assets. They may invest in the stock market or Bitcoin or somewhere else. And they can't really raise the federal funds rate too much because they could crush the economy, right? If they raise the federal funds rate more and we see bank failures or we see important businesses or institutions fall that are integral to the US economy, well, that's going to be one heck of a mess for the government to come in and clean up. And they're going to have to basically just inject trillions of dollars into the economy to do that. So really, all roads lead to inflation for the Federal Reserve and the US government. There's really no way out of this. This situation that we're in has been built up over decades. And, even with the amount of debt that we have and the situation we're in, we're still seeing the government spend so much money. And really, if you were going to attempt to get out of this inflationary situation, you would need to stop spending so much. And you really need to spend very little because you have to make up for all the overspending that you've done in the prior decades. And you really need to invest in productivity here in the United States so that we can get out of these deficits. But I really think the deficit issue has become too large, and we are really heading towards the failure of the US dollar and really just this whole system. And we'll see what system comes in and takes over afterwards. But like I said, people are saying this is bullish for the stock market. I'm not sure I agree. The thing about the stock market is stocks are businesses, and they're dependent on customers coming in the door and giving them business. And when I look at the economy, I'm seeing a lot of red flags. We're seeing more layoffs every day. Every day it's a report of another big business laying off thousands of employees. I'm seeing more reports of bankruptcies. I haven't really seen that many bankruptcies for big businesses and companies. It's more smaller businesses, but the longer we stay at this elevated federal funds rate, we're not at a super high rate, but we are seeing the economy weaken. And I do think if we stay at this level, this 5.25% to 5.5%, we are going to see some bigger businesses fail eventually. And that's going to send shockwaves throughout the economy. And that would probably lead to a stock market sell-off. Another thing is we just got the annual GDP growth numbers for Q1 2024. Now, I'm not a big advocate for government data, but we'll go ahead and mention it. The annual GDP growth for Q1 in 2024 was 1.6%, which is down significantly from the prior quarter, Q4 2023. In that quarter, the annual GDP growth was 3.4%. So we've gone from 3.4% to 1.6%, which is a pretty significant drop. I also want to show another chart here, the first chart here, which shows the amount of debt that has been defaulted on month over month or month by month. And we can see in 2024 that we are seeing the amount of debt that is being defaulted on rise significantly. And I wouldn't be surprised if we see more debt defaulted on throughout the rest of this year. And we see these monthly numbers head higher. Because when you think about this high interest rate environment, what does this do to borrowers? For one, it makes it very difficult to refinance, right? If somebody owes another entity money and they need to take out another loan to pay them in the meantime, it's very hard for them to take out a loan at these high lending rates. And really, the lending institutions, the banks, don't have a ton of liquidity to loan out because they are kind of in a liquidity crunch themselves. And just with more layoffs, more bankruptcies, that's going to lead to more defaults, right? If you take out a bunch of loans and then you get laid off from your job, well, you are quite probably going to default on some of that debt. There's a high likelihood. So I'm seeing a lot of red flags for the economy. One last thing I'll mention is we are seeing credit card delinquencies rising, but I just wouldn't feel personally, we may see the stock market continue to rise up because traditional investors just don't have a ton of avenues, right? They don't really know about Bitcoin that much yet. Gold isn't too easily accessible, at least the physical gold. So really traditional investors look at the stock market, the treasuries market, and the real estate market, I would think, unless I'm forgetting something else. And the treasuries market sucks, right? People are becoming aware that we have a very bad national debt problem, and we're seeing more and more treasury bonds issued every year, and that's only going to get worse. And the higher the supply of treasury bonds out there gets, it diminishes the value of treasury bonds. So I think people are leaning away from the treasuries market. Real estate has a barrier to entry, right? Not everybody has hundreds of thousands of dollars to invest in a real estate property, and most people can't take out a loan at, I think lending rates for real estate right now are around 7%. Nobody really wants to take out a loan and pay 7% interest. That's pretty high. So no, people aren't investing in real estate. They're not investing in the treasuries market. So a lot of people are just throwing their money in the stock market. And I think that's a big reason why it has continued to march higher and dodge economic hurdles. But I'm not sure if that's going to continue, especially if we see the economy continue to weaken. I think you would want to be in a asset that isn't as connected to this whole system, and I think Bitcoin is the best bet there. The last thing I want to talk about in this video is that interesting event that I mentioned at the beginning of the video. So after we got the Fed decision yesterday, we saw the the US dollar to yen exchange rate drop significantly, which means Japan came in and intervened. We've seen the US dollar appreciate significantly against the yen and really most currencies over, the past couple years as the US has tightened their monetary policy. And other countries are currently, they're clearly not that happy about this. And Japan sent a message yesterday. Japan is the largest they're the largest foreign holder of US treasuries. So they are in a unique strategic position, and they have a good amount of influence on the US treasuries market. And since the US dollar is appreciating against the yen significantly, what they did is they came in and sold off dollars or US treasuries and bought yen to prop up the price. And that is a problem for the US if foreign treasury holders are selling significant chunks of treasuries, because we already got a oversupply of treasuries out there. And if foreign entities start really selling out of the U.S. treasuries, that is going to lead to a big problem for the United States. So pretty interesting to see that. This is the second intervention in the past couple of days or past couple of weeks by Japan. So that's definitely something I'm keeping my eye on. So to kind of conclude this video and wrap it up, the US is in a very tough position. They can't really cut rates because it will lead to more inflation and problems for the treasuries market. They can't raise rates too much because that could be even more inflationary if they really crush the economy and have to come in with trillions of dollars to provide life support. And they can't leave rates where they are because foreign entities are getting tired of this dollar wrecking ball. And these other nations aren't happy that their local currency is being devalued against the US dollar. And they are making moves to show their displeasure there. That wraps this video up. If you're interested in gaining exposure to Bitcoin, check out my Swan Bitcoin link in the description. If you use it today, you can get $10 off your first Bitcoin purchase. Not a bad deal. If you didn't like the video and subscribe, please do that now. Appreciate your support. Thanks for watching. I'll be back soon.